strong dollar. We got soft stocks. It's risk off heading into the close. Bonds still selling off hard. Joining me, Nate Peterson, Director of Derivatives Analysis, alongside Mr. Jeff Kleintop, Chief Global Investment Strategist. Afternoon, guys. A dynamic duo for us here. Hey, Jeff, let's follow up on our convo earlier this week because we talked about kind of the potential for dollar to firm up here. We finally got it after a couple days of softness. What do you make of the action?
You know, the euro did pull back pretty sharply today. That was the biggest drop in the euro that I remember, I think, since like April 30th, the end of last month. But Oliver, it's still on its course for a first monthly advance this year. So that's something in the positive column. I think the divergence between the outlook for ECB rate cuts and the Fed rate cuts this year may have maxed out last month. We've now got markets seeing about 2 or 3 rate cuts from the ECB this year. And 1 or 2 from the Fed, and that's a 1-cut gap. But that was 2 cuts a month ago. So if it widens out again because data just proves stronger in the U.S., inflation proves stronger in the U.S., and that could widen to 2 cuts or 3 cuts again. You could see weakness resume in the euro, and a little bit of that today, right? So we saw in the beige book maybe some signs of inflation pressure here. We know container shipping prices have come back up. And even though German inflation ticked up on a year-over-year basis, it was actually down on a monthly basis. So makes sense that this gap between what the ECB and the Fed is going to do remained pretty consistent today, contributing to euro's weakness.
I like the way you describe it as the difference between the cuts because I've been kind of torn. I've had the yellow light on the dollar on my risk radar, but I'm so close to switching it green because it seems like yields have moved. You know, and what you're describing for kind of the market pricing in the full disparity of central banks does seem to be a little, dollar neutral or bearish, but it just the move in bonds now really picks up. How much of the treasury market kind of forces the dollar, Jeff? I mean, because that's what I look at and I go, boy, if the 10-year is really moving here, the dollar might have to catch up even more.
Yeah, I mean, I guess it depends. We're also seeing German yields move higher too. So it's a sort of a race to see whose yields can move up on a relative basis. There probably is more likely upside for U.S. yields than what you'd see in Germany, but we have seen really in Australia as well, around the world, rates have been moving higher, even on the longer end of the curve.
Yeah, it's a tough one right now. Nate, when you look at how these all kind of intersect around the economic data here, I mean, it was amazing to watch the market kind of move on Richmond Fed today, but we've had a few of those, over the last couple of weeks. Remember when we moved on like leading economic indicators, things that don't generally kind of rank top as movers. It makes me feel like inflation could be some action this week.
Yeah, it could be. Yeah, and if you remember last week.
Yeah, go ahead.
Oh,
Nick.
I'm sorry.
No, you're good.
Last week the inflation expectations from the confidence, the consumer confidence, kind of really markets honed in on that. Bond yields honed in on that. Treasury auctions this week affecting, obviously yields as well. Technically, if we look at what's going on with the market here, we talked about that bearish engulfing candle on the S&P 500 on Thursday. That's still in play. 5340 is what the S&P needs to do in terms of basically negate that potential bearish indicator there. But Oliver, if you look at the NASDAQ composite or you look at the S&P 500, or the semiconductor, the SOX index, you would think that, hey, things look pretty good. But then look over at the Dow, which is down 3.4% over the past 5 trading days. Look at the Dow transports, which are trading at a 6-month low today. Look at industrials rolling over. So there's this concentration, this narrowing. The money flow is going towards semis, going towards NVIDIA, going towards mega cap tech. That's where the perceived strong fundamentals are. But if you look elsewhere, things are kind of breaking down. So I think you really have to respect, technically speaking, what the VIX is doing. It's kind of reflecting what's going over on in the other indices. Look at the 1% drop today in the S&P equal weight. So let's not go to sleep that, yes, technology chips are doing well. Elsewhere looks suspect.
Yeah, I think it's a really good point. I mean, we've kind of taken a multi-sector hit today. The other thing, too, is that the international trade kind of hit a wall, Jeff, to kind of bring it back to that point.
Yeah, I mean, international slipping today. Although, it's interesting to see because there's a lot of different moving parts to that. One of the things that's interesting, though, and it's a little bit of a departure with what Nate talked about in the U.S. market, where cyclicals just are not doing well, a bit more of a defensive mode this month. In Europe, small caps have been outperforming. They actually outperformed large caps in the second quarter here by 3 percentage points. Pretty big gap here. It's the first time we've seen that in a while. I think that could be tied to the outlook for lower borrowing costs in Europe later this year, even though yields are moving up right now. And we're also seeing that traditional beneficiaries of lower interest rates are performing well, like real estate or utilities. So kind of interesting to watch that this sort of kind of a rotation back to small caps. We haven't seen that for a while.
Yeah. The potential here for us to kind of gain our footing again, Nate, what does that depend on? I mean, if we do see data come in light again, you think the market still spins that positive? That's still like the out, if you will?
It still seems like the algos are programmed to inflation data and yields. And so that for near-term price action, that seems to be what's dictating price action. So let's see what happens with PCE on Friday. We will get, Q2 revised tomorrow, and we'll have our quarterly PCE within that. That may not be enough, but, with the 2-year back near 5%, with the 10-year still in an uptrend in 2024, yes, if we start to get inflation data that cooperates, if we get below the estimates on the core PCE or the super core PCE year over year, that could bode well for it. But keep in mind, June, over the last 20 years is in the bottom quartile in terms of performance. So seasonality is not in our favor. I feel like right now it's skewed from a near-term perspective that we probably need to give some back and consolidate some so that we can kind of reset and maybe look for some of those encouraging economic data points to potentially move us back up into an upward trajectory.
Okay. Hey, when you look at the global impact on inflation, Jeff, does it seem like some of these economies firming up is maybe contributing a bit to some of the potential price increases, like if we look at sort of commodity producing areas and stuff?
We have seen imports pick up. We have seen more consumer demand. Consumer confidence has actually picked up in Germany. We just got the data there. So that is, I think, painting a little bit of a brighter picture. We're also seeing on the shipping front, I mentioned container shipping prices moving up. That's a little bit of pull forward of normal seasonal demand. So seems like things are ramping up a little bit. So better economic growth, better consumer spending seems to be translating into some more demand pressure as it relates to inflation. So we'll see how much supply can keep up with that. But at least in the near term, manufacturing output has remained fairly lackluster, even as demand has recovered. So that could lead to some pricing pressures in the months ahead.
All right. Good stuff, guys. Nice analysis. Thank you very much. Nate Peterson, Jeff Kleintop.